Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He covers the oil and natural gas markets in depth. He's the chief investment officer of a hedge fund that invests in publicly traded oil and natural gas stocks in the US and Canada. Josh Young of Bison Interest. Thank you for joining me again.
Thanks for having me back.
So, Josh, we're recording this interview on Friday, May 30th, 2025. West Texas Intermediate, it's at the bottom of a trading range around a little over $60 a barrel right now. I want to ask you, though, about the signs in a cycle for the signs that we would see in a cycle for the bottom in oil prices. So, what signs do you think we would have to see for a bottom in oil prices?
Yeah, I mean, you're saying it's a trading range, and it's possible that that oil prices have bottomed and they're going higher in the short term. It's also possible that prices fall a lot more in the short term. What I find happens with commodities is they'll trade roughly in line with fundamentals for long periods of time, and then there will be some sort of catalyst and some sort of disconnect from fundamentals. And once they untether, it's possible for them to move wildly. Like the fair price for oil certainly wasn't negative $40 a barrel in 2020, and it also probably wasn't $150 a barrel before adjusting for inflation in 2008. So I think it's sort of hard to tell. I would argue that the price untethered um, probably some point late last year from fundamentals. And we're at a point where when you look at global inventories, and it's easiest to measure US inventories, and you look at the difference between US petroleum inventories and prices, the price should be closer to roughly $85 a barrel. And so since we're untethered, it's really hard to say, hey, oil won't go down another $10 a barrel or something before it trades back up towards its intrinsic value.
Now, in terms of sentiment, I've seen sentiment indicators, I think, over the last 4 to 6 weeks that we're at 20-year lows. Is that done the commitment of traders for oil futures contracts for bearishness for oil? I think it's at pandemic levels or worse. Have you seen these types of sentiment levels with oil prices at basically at not at $30, $40, at 60?
Yeah, I mean it's pretty amazing. I think I agree. So there's the quantitative measures that are easy to point to, like net speculative positioning of futures contracts, and then you can see other things too, like the relative performance and valuations of small cap oil and gas equities and smaller oil field services companies versus the larger oil and gas equities as sort of a measure of fear and negative sentiment. But you can also see, I'm probably too active on Twitter or X, and any sort of positive perspective on oil or oil and gas related stocks is met with enormous amount of skepticism and fear or condescension or whatever. And so, those sorts of social sentiment measures are pretty helpful too, although they're sort of more qualitative than quantitative.
Yeah, one of the ratios for commodities ratios is the gold to oil ratio. So one of my other friends, Dan Stefins, in Dallas area. Well, actually, he's in Houston, but he goes back and forth between Houston and Dallas for luncheons for a lot of oil companies at the Energy Prospectus Group, and he's a former senior executive at Hess Oil. He sent me a chart for the gold to oil ratio, telling me that like it's way, way out of whack. But I think there's just huge demand on the gold side. But I think in terms of valuation, like there's a lot of bargains in the oil space right now.
Yeah, yeah. I mean, look, I think when you see things this out of whack, generally that's a good signal that there's going to be real mispricings. And then when you see not just in terms of the sentiment indicators, but also real dollars and real people, there are a number of people that were quite bullish oil in 2020 and earlier who have capitulated and are now quite bearish, various fund managers and analysts and so on. And I think there's really been sort of a depopulation of, let's say, the bullish oil crowd to the point where it gets a little when it gets this lonely on the bullish side, and when it's this hard for news anchors or news shows or they hosted a debate end of last year and couldn't find anyone other than me to present the bullish case for oil. I think it was Zero Hedge that hosted that. I think it's pretty promising. I'll tell you, I don't think I've talked about this publicly yet, but we're actually looking at, I looked at launching a newsletter in 2020 and for various reasons didn't at the time, but the idea was that there were a number of small caps that were so undervalued that there was a good shot with no guarantee that they could go up 10x or more if oil went back to 100. And I didn't launch it partly because of the immense ridicule I got just within, among industry friends and investor friends to even think that oil would go back to 100, in 2020 with oil at 40, I think it was at the time. And so we're actually looking at launching something similar just because there's a ton of these small cap producers and services companies and sort of related weird securities where there's an easy case I think that they could go to zero, but they could also go up 10x, 30x. And there was actually one I talked about on TV, which was pretty amazing. In I think it was late 2020, where it was at 20 cents and it went to over $5 and then to zero. So there could be a lot of really interesting things that happen as this sentiment, maybe it gets more extreme, but as it sort of rationalizes eventually, I think there's a good shot that we eventually slingshot way to the upside. And there's a lot of stocks of producers and service companies and other sort of companies related to in the oil and gas space that could go up quite a bit from here.
And as you laid out, it's very difficult to be contrarian and be a fund manager because you have career risk. So if you're wrong on the timing there, being contrarian, even if the risk reward is good, you have people pulling out your funds, trying to, take the cash, the assets under management out at the wrong time. So that's why you have a lot of fund managers try to have a lockup period there. So because people are trying to take the funds out at the wrong time sometimes.
Yeah, yeah. Let me talk about that just for a second. So one, we've been really lucky at Bison. We've actually had some inflows recently into the fund, so that's pretty exciting, and it's great to get to deploy capital here. But part of I think what's been happening in capital markets broadly is there's been a move towards passive investing, at least on the public equity side, and indexing, and so. I think there's been this move more towards an expectation of providing sort of essentially potential investment ideas rather than custodying assets. And so I think there is a move towards career sort of cautiousness or conservatism among fund managers to try to preserve what they have left. And our mutual fund, Harris Kupperman, put out something he's very bearish, and so he's saying, look, like this isn't great for fundraising, but I'm just going to take my chips and hang on to them and go towards cash. And I think my perspective maybe is even less popular than that, which I'm going to go buy some even more perceived risky oil stocks, and I think I'm going to go sell some newsletters talking about some really potentially risky and potentially high torque. And I think when you do like the right thing and the thing that makes sense to you from an analytical and risk adjusted potential return perspective, I think you find sort of your right audience and your right potential buyers or investors.
And I think we could see mergers and acquisitions on a value side here because there are rumors going around now, whether it's Royal Dutch Shell, ExxonMobil, or Chevron looking at BP. I've heard it, whether that's Reuters reporters on oilprice.com that have good sources. And so it's widely reported that, some of the larger companies that don't have a lot of debt on the balance sheet that had free cash flow over the last couple of years with a higher oil price and are doing pretty well on the natural gas side, they are looking to go buy assets that they think are deeply discounted.
Yeah, I mean, there was a deal today, EOG, which very rarely buys companies. The last company they bought was Yates Petroleum in the Delaware Basin in West Texas and southeast New Mexico. The last deal they had done was 2016 over there of scale. They just bought Encino for it was what, $6 billion plus or minus a little bit, and so that's a great sign. And it's been one of these weird things where you see where asset allocators are putting their money, professional fund managers and endowments and foundations and so on, and they're running away from oil. Some of them are running towards natural gas or various stuff in like AI, power gen, data centers, whatever, but running away from oil. And then you look at these companies and management teams that have just some of the best track records over decades, in some cases, of capital allocation, and they're going and buying oil assets. And so it feels pretty comfortable on the in the financial world. I think I'm like pretty lonely, but on the asset allocator world, frankly, some of these guys I think are might be a lot better than me at timing asset allocation and being careful about asset allocation. And I feel like I'm sort of standing on the shoulders of giants that are going and just they're pulling out their elephant guns and they're doing their once every 5 year or once every 10 year sort of acquisition. And actually, we actually have some drilling interests in the Ohio oily Utica shale that we're invested in at Bison. And so it's pretty on a more direct basis, which is very unusual for us, but just the returns there were so compelling. So, yeah, I think I'm really aligned. I don't own any EOG stock or anything like that, but they are great at asset allocation and they are great at drilling highly economic oil wells. And it's going to be sort of exciting. We're actually going to have them drill even more wells for us on that investment because of this latest deal. But like you said, M&A is picking up, but if you pay attention to who's buying and what they're buying, the guys buying assets, the companies and management teams buying assets on the oil side, for the most part, have some of the best track records out there. Now is the time, it looks like, based on the signals from EOG and other top performing management teams and companies, to go buy oil assets.
I want to ask you about normally when OPEC cuts production. I would have guessed about 6 months ago that if the oil price had gone down to these levels, that the Saudis and OPEC would have strongly considered additional production cuts. Do you think that the Saudis and OPEC are kind of doing President Trump a favor? Because whenever I listen to business television or Fox News or any of the cable news, there's Trump administration representatives going on saying lower oil prices, lower gas prices, inflation will come down, consumer price index will come down. They just repeat this every single day with whatever guest comes on. So do you think like the Saudis and OPEC are doing Trump a favor right now?
It's a good question. My framework for the last few months has been this is a market that's been sort of similar to 2018, where Trump was telling everyone that he was going to cut back oil supplies from Iran, and the Saudis and OPEC broadly believed him, and they brought production back on, which crushed the market for oil temporarily when Trump deferred his sanctions enforcement and then implemented it later in the year. You can see the charts for Iranian oil production and oil exports falling off in late 2018. And by 2019, you saw the market recover for oil. And towards the end of 2019, I think people forget this, but oil was starting to tick into the 60s again after falling to close to $40 a barrel at the end of 2018. So it recovered by roughly 50% or so. And I think it might have even been in the mid 60s going into early 2020 before the COVID shutdown. So I think it's sort of a similar setup where, again, I don't know exactly where it bottoms, but this looks a lot like that sort of 2018 setup. So is it doing Trump a favor? Is there sort of a quid pro quo where they're bringing back on capacity or back on higher quotas at OPEC Plus in exchange for this? Or is it some other driver or some combination? But I will say, I think I got the OPEC cuts wrong in the last few years, where those were actually, in retrospect, quite bearish. And I think I was taking it at sort of simplistic level where, hey, OPEC cuts production, that means there's less oil coming onto the market. That means oil prices should rise because prices should be set on a supply and demand basis. But the market for oil is quite complex, and people understood that there was spare capacity available, maybe less than people were saying, or less than some of the optimistic analysts were saying. But there was still spare capacity, and it was apparent that the Saudis and others were using their spare capacity as sort of quasi inventory. So having gotten that wrong, then looking today as the Saudis and broadly OPEC Plus bring back on production and capacity, their exports haven't risen yet, but I would expect them to rise somewhat over the course of the year, especially if, I mean, this is a risky interview to do because early over this weekend and then early next week, we're going to see how much oil OPEC is bringing on in their latest monthly accelerated increase. But even with that, I think there's a good shot here that we end up with actually higher oil prices as OPEC brings production back onto the market. And I think it makes sense to pay attention to them, given that they're calling this not a price war, which I think they were pretty open about in 2014 when they brought production back on, and even in early 2020 when they had their price war. I think it makes sense to pay attention to what they're signaling, which is that they see higher demand, they see limitations to supply, and they're trying to avoid this scenario we just described of potentially much higher prices. And it's possible they're actually a little late for avoiding that, and that they are bringing production back on based on demand signals, and that we might end up with OPEC bringing production on and a much higher oil price, just like when OPEC cut back over the last few years, we ended up with a much lower oil price.
Are we seeing a lot of the other OPEC members besides Saudis? Are they actually cheating on the production quotas? Because I interviewed another expert a couple days ago, and he was saying how some of the other OPEC countries are producing above the quota right now.
Yeah, so that's been an issue. Kazakhstan's been the big one. UAE, there was sort of a tacit agreement that UAE would be cheating a little, and that was just sort of, I think, part of the deal. Kazakhstan repeatedly publicly lied about cutting back their production and finally capitulated and said they do not plan on cutting back their production. And then Iraq has also been cheating. It had been theorized that Iraq was just helping Iran smuggle out barrels, but seeing how much production Iran was able to bring out as the Biden administration and now the Trump administration were lax on sanctions enforcement or waived sanctions, it does look like this is actually production from Iraq. And so you have these three countries in particular that have been producing above their quotas. And then you have Iran with close to 1 million barrels a day of incremental production online into the market, despite sanctions. So yeah, you have some cheating and you have some overproduction, but there's different ways to look at things, right? The pessimist looks at that and says, "Oh, there's cheating, therefore there's OPEC dissent, therefore oil prices must go down." The optimist looks at it and says, "Hey, wait a second, there's supposed to be 6 or 7 million barrels a day of spare capacity at OPEC plus." Well, if they're cheating and there's this extra 1 million barrels a day plus of supply from these three countries, plus an extra 1 million barrels a day of supply from Iran, plus, those spare capacity numbers were grossly overstated because no one ever really revised them. Just everyone just took the countries at their word for what they could produce. Maybe we're a lot closer to being out of spare capacity. And again, I'm not saying we're out here, but maybe there's only a couple 1 million barrels a day left to go from here rather than the close to six that's consensus. And if that's the case, then there's way less impetus to go bring that remaining production back on. And once you have a few 100,000 more from the Saudis after their peak summer demand season domestically, maybe there isn't a lot more to come from OPEC plus. And if that's the case, then that's your scenario for OPEC having raised their quotas quite a bit and potentially much higher prices into the summer and maybe into the fall.
Do you think that the Saudis and OPEC are are generating a lot of free cash flow right now? Because I've seen some of the announcements out of Saudi Aramco, and you've posted some of this on your X account over the last month or so, whether it's large dividend cuts from Saudi Aramco. I think they just started floating some corporate debt. And now we're starting to see for the Q1 earnings for a lot of these Permian Basin oil and natural gas producers, they're announcing absolutely enormous capital expenditure cuts of $100 million or more across the board. Are these normally signs that the producers, the oil producers, think that the oil price either is at or below the cost of production or close to a bottom?
Yeah, there's a few questions in there, and this is a great important aspect of the oil market. So, first of all, on Saudi Aramco, Aramco clearly could not afford their dividend, therefore they cut it. Cutting that dividend really hurts the Saudi government's finances as well as their credibility, because when they went public and when they did follow-on offerings, they promised everyone that they would maintain that dividend and they made representations around the very low cost structure for Saudi oil production and for Saudi Aramco. And it turns out that lo and behold, their cost structure is higher such that they were not able to sustain their dividend. And it did not take oil prices falling for very long before they had to do that $10 billion dividend cut. So that's a signal that their break evens are much higher. I don't interpret that as them expecting oil prices to stay low for very long. I just think it's more of a signal that their cost structure is actually much higher than they've said and than people think. In terms of oil companies cutting, we've already seen budgets being cut over the last couple of years. In some cases, they've been hidden via merger and acquisition activity where companies have cut their capital programs, done acquisitions, and sort of hidden their slowdown in drilling activity. And I think the mess around that, as well as the sort of not economic impetus on a well economic perspective, but just to try to get more production to sell for a higher price, has been an impetus of drilling activity to be able to get some of the deals we've seen done in the last few years. And now that those deals have been done and are being digested by the acquirers, we're seeing capital continue to fall. I think the signal for break evens, at least from a corporate perspective, to hit minimum return thresholds is closer to $80+ a barrel, especially with low local realized natural gas pricing in the Permian and elsewhere. And it may actually be even higher than that. So I don't think it's that we've suddenly hit some sort of economic break even or below break even point that all the companies are cutting all at once. I mean, there was a more risk aversion and more concern after Trump announced his very large tariffs and introduced a lot of tariff uncertainty on April, what was that, April 2nd. But even before that, we saw a lot of rigs falling off. And so I think there's a lot of confusion around that. I think the combination of well productivity improvements in the last few years, along with high grading of drilling locations, has hidden some of the declines that are embedded with the rig and broader sort of investment declines. And I think we're just starting to see the impact of that in recent EIA reports and in recent production numbers from the companies and from industry assessments. And so I think as those roll forward, we actually need to see a lot more rigs active just to keep production flat and to arrest the inertia and momentum towards much lower production levels. And absent many more rigs running, I think you end up seeing potentially production down, crude oil production down by 500,000 barrels a day or more from the start of this year to the end of the year, and on a trajectory for further declines. And then on the NGL side, I think you could see the very rapid growth in NGLs shift. I don't know if we go to declines in NGLs, but we could go from growing 500,000 barrels a day or more of natural gas liquids to growing close to 100,000 barrels a day. So that would be just an enormous change in trend from what had been a period of many years of supply growth, particularly on the natural gas liquid side.
Yeah, to add to your points there, Harold Hamm from Continental Resources, he did an interview publicly in the last couple weeks. He was saying $75 a barrel West Texas Intermediate to maintain the current production levels. He basically said it's uneconomic. But then I interviewed Dan Stefins from the Energy Prospectus Group, former senior executive at Hess Oil. He was telling me a lot of these shale oil wells are still payback period is under 18 months. You pay like $6 million or something like that to have the well drilled, and you get your payback period quickly, and then it's pure free cash flow after that. So he was calling like Harold Hamm's bullshit, but I would tend to, based on the capital allocation of these larger publicly traded companies, Josh, that you track, agree more towards Harold Hamm that there's not a lot of economic incentive for these oil producers to grow production right now.
Well, I think they're both right. And so here's how you split that difference. It's part of actually why I started investing at the well level, and which actually has worked out so far. We had some issues with the guys that put it together, but which is one of the risks on doing asset level deals rather than corporate level deals. The corporate level deals, you have to worry about the management teams. The asset level deals, you have to worry about the folks getting you into the wells and so on. But the wells themselves have been spectacular, and the thing is, when you go from single well economics, where you're literally just coming in, writing the check, funding the AFE, paying a little for the acreage, to investing in a corporation with hundreds or thousands or tens of thousands of employees and balance sheet challenges and all kinds of other dynamics, you go from single well economics that could be using those numbers with a 18-month payout. You're talking about what, like a 40% or 50% or so IRR, depending on the exact decline rate and so on for the wells. You could go from 40 or 50% IRR, which sounds good on an individual well basis, to a corporate return that would be below 20%. And depending on the cost structure, potentially below 10% at the corporate level. And so if you just think about what that looks like as a shareholder, you're sitting there looking at inventory that's very valuable, that earns really good returns, being depleted in order for your money to only earn less than a 10% return. And then in many cases, the management teams and boards take a lot of that as incentive compensation, rewarding themselves for their poor capital allocation. And so that's, I think, where you get, I think Harold Hamm is looking at it from a corporate perspective because his world has been for many decades now owning and running Continental Resources. And he's looking at things as the owner of a E&P company, whereas looking at it from an individual well basis, you can still make good money if you don't have to bear the burden of these multiple layers of overhead and expense and so on. So that's, I think, how you split that difference. The way companies that are really successful at this do it is they only invest when they have 100% rate of return at the well level, like EOG claims. And you look at their Utica acquisition, they show at $65 oil and I think it was $3 gas, 200% rates of return on average for their Utica wells. And so, if you invest like that, maybe you get a 40% corporate return or more. And that's where there's really good returns, but that's very, very rare. And I think Harold Hamm, I mean, I looked at that. I listened to his interview a few times and tried to tie some of the numbers. And it sounded to me like he was saying that the right number from a corporate perspective for the average upstream producer was closer to $80 or $85 WTI, which I would point out is right around the point where you started to see persistent rig declines, was when oil prices fell below $80 a barrel and didn't tick up above that for more than a few days or weeks over the last few years.
So this balancing act that you just described over the last couple of minutes, it sounds like a huge, huge challenge for a lot of these publicly traded companies because a lot of them have done acquisitions over the last couple of years. They've absorbed them. You mentioned that they cut capital expenditure. They also let go of some employees with synergy. They're trying to become more efficient, but yet the oil price is low and there's not a lot of incentive to grow production. Do you agree with the CEO of Diamondback Energy about the challenges going forward to grow oil production in the Permian Basin?
Yeah, I think in the Permian, growth is quite difficult, particularly at current prices, partly because the local price for natural gas has been zero or negative recently. And last year it was negative over, I don't think it was negative 100% of the time, but there were 5 or 6 months in the year last year where natural gas prices were negative. And so that's really bad. And that really hurts the economics on these wells that initially produce mostly oil, but over the life of the well produce a substantial amount of natural gas. And so I think for that sort of setup, you really do need much higher oil prices. And I think people forget that there is significant reserve depletion, especially if you think about it from a total acreage perspective rather than just booked proved producing or booked proved reserves. And so there's not really enough of an exploration effort going on. You see validation of that claim and that thesis by companies like EOG going and spending billions of dollars to buy additional land in areas where other companies like Encino have spent the money to explore and delineate assets. And I think there's going to be a real issue where what you should be seeing right now, and I'm not telling any individual company to do this because they're correctly responding to the low price signal by cutting back on their development capital and they're slowing, for the most part, the smarter management teams and the better capital allocators are slowing the harvesting of their tier one or core locations, because even if you can earn a good return here, you can earn a better return at a more normal mid-cycle type commodity price. But what you're not seeing is the staffing up to go do the exploration and delineation that's going to be necessary to be able to have locations to develop 3 years from now, 5 years from now, 10 years from now, and so on. And so I think when people say, oh, shale is dead, they're sort of looking out and they're seeing what the likely ramifications are going to be of exploration and production companies having shifted almost entirely to being production companies. And when I see that, and I talk a lot about this, about the long cycle for oil and gas and how there's underinvestment, people point to the short-term production level and the short-term price and say, oh, that's wrong. And they ignore that over time, what you care more about isn't the short-term production level or short-term price. You care about reserves and sustainability from a reserve perspective, as well as depletion of available high return inventory. And so there's just not enough of that. And so that's why I think when you look through what's happening right now, you see this potential for much higher oil prices. And ultimately, many of these companies that are cutting rigs or have cut their exploration budgets to near zero will be spending a lot more money. Frankly, they'll be paying higher day rates for the same rigs they could be using or lower quality rigs to go hire some of the same people they could be paying now that they're laying off and they're going to have to go pay more money for, to be able to go do some of the exploration or development that they should be doing now that's getting pushed off. So less development, but more exploration delineation should be happening right now. So yes, I totally agree with Diamondback. I think they're right to not go aggressively deplete their very expensive, very valuable core inventory. But at the same time, I think companies like EOG going and making bottom of the cycle or potentially near bottom of the cycle type acquisitions like they did today with Encino, is brilliant. And then, you look at EOG and other forward-looking companies, and they're starting to spend in a big way again on exploration. And again, I think you just look around and say, hey, which teams and which companies have earned the highest returns over this cycle and over multiple cycles, and what are they doing? And what you'll see is those companies are doing acquisitions here, and those companies are investing in exploration here.
That super cheap natural gas price in the Permian Basin, do you think more pipeline capacity coming online would fix this, or do you think it's gonna, by the time the pipelines are online, maybe some of them are, I thought some of them were under construction with the Matterhorn from One Oak or Enbridge or Plains All America. I thought they were building pipelines. You're saying that that's not enough, that there needs to be a lot more natural gas pipelines to get that gas either to the data centers in Texas like Stargate AI or to liquefied natural gas export facilities?
Yeah, I mean, if you look at local realized pricing for natural gas in the Permian Basin over the last 2 decades, I mean, you can see the whole low prices are the cure for low prices and high prices are the cure for high prices um, thesis play out as its own sort of like mini cycles. So you see overbuilds and you see underbuilds over and over again. And you see local prices as high as $9 an MCF and as low as, I think, -7 last year was the lowest price. And so, yeah, you see real cyclicality. The Permian has an enormous amount of natural gas there, both that's being unlocked currently with current oil-oriented development, as well as fields that have been discovered already for the most part, tested already to some extent, and are just sitting there because why would you rush to drill highly productive, very valuable natural gas today if you can wait for more pipelines to be built and then bring on more production into a much better pricing scenario in the future. So I don't think there's a need as much for exploration on the natural gas side. I do completely agree that we need a bunch more pipelines to and from West Texas and Southeast New Mexico to take out the gas and to a lesser extent the natural gas liquids. And some of that will come and is going to go to LNG projects. Some of that's going to get built. Some of the demand for that's going to get built in basin where you're seeing multiple different large gas powered data center projects and some industrial build outs too, which is wonderful. There should be a lot more of that, but I just want to be careful with it. With oil, there's this enormous underinvestment that's happened, and there's a huge potential for much higher prices because of just the many, many years of cumulative underinvestment and exploration in the Permian Basin for natural gas takeaway, we're one or two pipelines away from there being excess pipeline capacity, at least in the short to medium term. I think over the long run, those projects should do fantastic. But there's a lot of risk, I think, to the downside from a cyclical perspective, where I think we will get overpiped at least temporarily at some point in the next few years, just because we have experienced that repeatedly in the past and you could see quite high prices for natural gas, which is going to be great, I think, for my investments in producers that have a lot of natural gas exposure there, but also could end up being painful for the pipeline companies and gathering and processors there who have been earning an excess return recently and may flip from an excess return for the ones that take price risk to a much lower return. And so, again, I just want to be careful with that. There is cyclicality in both directions there. And I think there's a reasonable shot that we end up with much higher prices in basin for the Permian for natural gas for a period of time before we then may end up reverting back to low prices.
A lot of energy investors and also a lot of generalists, so like institutional investors, pension funds, they seem more interested in hitching their wagon to all the big technology companies that are spending tens of billions of dollars in capex each the last couple of years for artificial intelligence software data centers. So they seem more interested, to add to your points there, in investing in, say, nuclear power, next generation nuclear power, small modular reactors, making sure that they're building a data center near a nuclear reactor, or getting a natural gas supply like Elon Musk in Tennessee with the Colossus data center from XAI, or with the Stargate facility that's going in Abilene, Texas there. I think Chevron and General Electric is building the turbines. I think Chevron's building a plant there.
Yeah, I mean, look, like the impetus right now, to the extent that institutional investors and fund managers are interested in energy, they seem to be almost exclusively interested in investing in that sort of natural gas value chain down to power, down to data centers or LNG facilities and exports. And I think when everyone's on one side of the boat, again, it's not that that's so crowded, it's that it's relatively crowded versus the oil side. And so you look at EOG, and you even had people saying this asset that EOG just bought that's 50% oil and natural gas liquids and has likely 80+% of its revenue and cash flow coming from oil and those natural gas liquids. They had people calling it a gas asset, I guess, because it just fit their narrative better, which again is just wild from an industry perspective. That's an oil asset, not a gas asset. So you have all of the money from an institutional financial world perspective, rushing in and crowding into the natural gas side. You have natural gas producers, which maybe it is fair for them to trade at high single digit to low teens EBITDA multiples. But it doesn't make a lot of sense to me to go rush to compete to buy a large cap natural gas producer at let's say a 10 times or more on a trailing basis EBITDA multiple when I can go buy an oil producer at a 2 times trailing EBITDA multiple. And again, EBITDA is not perfect, but just to use that as a high level metric, it's pretty wild seeing people sort of who, especially many who had been very valuation focused, throw valuation out the window and rush into this natural gas trade when there's so much value on the oil side and such a better story, I think, in terms of underinvestment, where there will be likely growing demand for natural gas, and I'm still bullish on natural gas, but just having to pay 4 or 6 or whatever times more from a valuation perspective to get exposure to these natural gas producers, having to pay, in my view, a almost crazy high valuation to get into the pipelines supplying them, and then these LNG facilities, which the contracted ones should do fine, but uncontracted new LNG facilities may have trouble selling their spot volumes for as high a price as it looks like they're underwriting, just because there's so much construction. Again, it's wonderful for upstream investors. I think it's wonderful for oilfield services, but and for the prospects for oilfield services over the next few years. But I'm not sure where the returns are going to come from on those spot volumes if there's a lot of capacity available relative to the amount of supply and relative to the potential demand.
So it sounds like some of them are being built on speculation there, then that in the past, these LNG facilities were only built if there was long-term contracts at a good profit before the capital expenditure, many billions of dollars of capital expenditure was built to build these LNG facilities.
Yeah, I mean, or you look at some of these projects and maybe they'll be 60% or 80% contracted, but if you look at the returns and what seems to be driving some of the equity valuations, I mean, there's not that many of these that are publicly traded, but you look at their valuations and they embed returns from periods of time where European natural gas prices were $50+ an MCF, and not anywhere close to that now. And maybe they'll get back to that or maybe not, but I don't know why I would want to pay a multiple on an infrastructure asset, embedding some high probability of prices returning to those levels for some period of time in order to get that sort of excess return that you saw from the spot volumes that these LNG providers achieved. So again, I think it's just a question of setting expectations and being willing to be on the side that's seeing capital outflows, especially on the smaller cap side, and despondency and extreme pessimism, and being able to buy at a much larger discount to replacement cost at way lower multiples on run rate, operating cash flow, and in some cases, free cash flow, and then having the shot that, to the extent that the scenario I think is most likely plays out with that sort of 2018 type setup, along with some of the right tail from geopolitical risk, as well as broader economic growth on the back end of the tariff issues as they get resolved and as we see more money printing by various governments, and maybe some of the risk that the gold investors are seeing in terms of broader inflation across currencies that could bring money back into real assets. As you see that play out via gold and then into oil, I think there's a good shot at $100 plus oil, potentially much higher over the next few years. And seeing these oil companies that in some cases are trading for two or so cash flow, the times their run rate operating cash flows, and for tiny fractions of the replacement cost of their assets, trading up 10x or more. So I'm really excited about it, and it's a very weird situation to be almost truly alone as an investment manager looking at this and seeing many of the people that could see clearly through this in 2020 giving up on a scenario that to me actually looks more compelling, both because there's so few people taking this position and because of the low valuations and the many more years of insufficient exploration and appraisal and the inventory that's been blown through in between 2020 and today, especially on the shale side.
A last question here. I know you invest a lot in Canadian oil and natural gas producers that are producing already. They're not exploration companies necessarily, or not just exploration. They do some. So they were low cash flow multiples. They had free cash flow. With the new pipeline that's coming online and expanding with the Trans-Canada pipeline that's taking the landlocked oil from the Alberta area, Edmonton and Calgary area to the West Coast there to a terminal for exports. Are those Canadian companies starting to see a lot better prices now on the oil and natural gas that they sell?
Yes, on the oil, because Canadian government has been borrowing and spending like drunken sailors, and so they've really depreciated their currency even versus other currencies that have been doing similar, like the U.S. dollar. No on natural gas. Unfortunately, it's looking more and more likely that this first LNG facility coming on in Western Canada will have a similar effect to the Matterhorn pipeline coming on in West Texas, where it's really needed and it will help debottleneck the basin to some extent, but it's just probably not enough and it's too anticipated. And so hopefully it raises prices a lot in basin, but I think there's an elevated risk that it should be around 2 BCF a day. Maybe it'll end up closer to 1.5 BCF a day, maybe it'll be a little over two. We'll see in terms of the actual volumes it ends up getting to export. It's been interesting seeing these different LNG facilities, how much they actually export and then what their uptime is. And hopefully it'll be on the high end and hopefully it'll be enough to debottleneck, but there's been a lot of drilling activity in Canada oriented towards the natural gas side. and not all of those wells are on production, and many wells were drilled historically anticipating this LNG facility. So I think my message would be, hey, you need probably three or four more projects like this to really fully debottleneck Canada and to get persistently reasonable natural gas prices, absent a huge shift in the U.S. too, which may happen. But if Canada is going to sort of debottleneck itself without depending on a super bull market for natural gas here in the U.S., I think you might need, you need this LNG Canada 2, the expansion of this facility to come on. You'd probably need an expansion of this Coastal Link pipeline, which was built to be pretty big, but arguably not enough given the huge resource available at relatively low costs in the Montney and Duvernay shale plays in Canada. And so, unfortunately, I think we may just see a lot of disappointment, similar to what we saw in West Texas, where Matterhorn came on and it debottlenecked things, and prices got okay for a little while, and then prices got crushed again, ahead of the next couple of pipelines and data centers and other stuff that should be coming on in West Texas in the next couple of years.
So it sounds like Canadian companies that have a larger percentage, over 50% oil production compared to natural gas, have an advantage, unless they're similar to what Journey Energy, where they're setting up their own electrical utility plants that are using the natural gas. So they're going if they have to move the natural gas across the pipeline, they're at a disadvantage. And if they're producing 50% or more natural gas compared to oil in Canada, they're at a disadvantage then.
Yeah, but they do actually have to build the plants that they're saying they're going to build, and they have to spend a reasonable amount in order to get them built, and they need to turn on and stay running and so on. So there's a lot of, vertical integration has its advantages, but also has its risks and challenges. And management, execution, and board oversight is really important in actually going from a good idea to value creation. And so that I would emphasize caution on that front.
Exactly. Yeah. It's one thing to have a good business plan and the plan sounds good. It's a whole entire other thing to execute, especially if you don't have the expertise in it. And then there's hidden costs and the profit margins might not be as expected. And you have all these capital expenditure overruns. See this all the time in the mining space.
Yeah, and to be fair, there's cost overruns across the power space right now. So that's not unique to any one particular company. But where you see companies, run into multiple years of delays and cost escalations, and with multiple different excuses. The more than one excuse and different excuses to different parties, depending who they're talking to or where their filings or reports or presentations are or whatever. I think that's where I'd be more careful. But yeah, I think like the one mitigating factor for Canadian natural gas producers is that while many expect prices to get better, they have not been very good. And so I'm not saying that I think natural gas prices in Canada will get a lot worse from their abysmally low levels once LNG Canada comes on. Hopefully they'll get better, but it's just a question of, do they get 10% better? Do they go from terrible to just a little less terrible? Or do they go from terrible to really good? And I think there might be too much optimism that prices go from less than $1 an MCF right now to $4 or $5, where maybe they go from $1 an MCF to $1.50. Again, 50% improvement, great, right? But not really what the forward curve is showing, and not really what a lot of investors are looking for or management teams are showing in their economics or so on. So I think there's a lot of risk there. And the drilling activity, again, you look at the trajectory for drilling activity for oil in West Texas, across the US, frankly, across the world, and it looks really promising from a supply perspective, where if demand just hangs in there and continues its longer term growth trend, you could see much, much higher oil prices. The supply trend for natural gas in Canada looks very different, where the activity is quite robust. The excuse has been that this LNG facility is coming on, but there is a lot of risk that there's too much expectation of this one facility, and that any sort of maintenance events, any sorts of delays, or just the abundance of gas in basin currently at ECO and Station 2 could lead to a period of disappointing prices, even if they are higher than the current ultra depressed prices, particularly at Station 2.
Yeah, the natural gas supply sounds like a boom, and then we could have a bust similar to the shale gas bust that we had in the United States, what, in 2013, 14, 15, that there was so much natural gas and it just crashed the price.
Yeah, it could be. And then there's the other mitigating factors, like there's a huge data center project that got announced and hopefully will get built out sooner than later. And there's also the possibility that you end up with some natural gas getting called on by a quite strong market in the US. If you look at the broad Appalachian gas production, it's been lower than a lot of analysts had forecast. And so you could end up having a call on Western Canadian gas into the dawn Eastern Canadian natural gas market. And to the extent that there is that call on gas, you could actually see quite a big price improvement. But again, that's not driven by I mean, the LNG facilities would be helping in that case, but that would be more driven by this broader US bull market in natural gas. So that would be almost it would be wonderful if that happened, and there's some chance of it, but that would be sort of an exogenous event driving the price up rather than sort of the basin itself sort of figuring out its own supply and demand dynamic.
Well, Josh, I really enjoyed our conversation today. It sounds like the oil market, we're going to start to see even more capex cuts if the oil price doesn't go back up here in the Permian Basin. And pipeline companies sound interesting. I thought there was going to be plenty of pipeline capacity brought online with Matterhorn. Some of the others sounds to me like you said that there's still not enough pipeline capacity, so there's opportunity there. I'm surprised. I thought they were spending and the pipelines were going to be plenty that were coming online over the last 6 to 12 months.
Yeah, I mean it's I think some folks were pessimistic and some were optimistic, and in this case the pessimists were right, and supply of pipeline space was insufficient versus supply of natural gas. And fortunately, what it looks like based on that is there will be even more data centers built in West Texas, and there will be even more takeaway capacity built from West Texas and Southeast New Mexico. And it does appear that there's more attention now than there's been in many years on these various highly productive natural gas zones and resources in West Texas. And so, I think we could see a natural gas development boom along with significant pipeline projects to bring way more natural gas out of basin as well as to consume it in basin. And so, I think there are great development prospects there. But again, I would just caution that there's likely to be two-way cyclicality there for natural gas prices as well as for uncontracted or sort of variable economics on the pipeline side.
I want to thank you again for your time today, Josh. Please tell my listeners more about Bison Interests.
Sure. Yeah. So none of this has been a recommendation, offer, or solicitation. Run a investment advisor that advises an investment strategy that invests in small cap publicly traded oil and gas companies. We've done a couple of small private deals and maybe launching a newsletter shortly to share some of the more off the run, potentially high return, but also very high risk opportunities that we've come across in the latest sell-off.